Hello and welcome to The Enterprising Investor, the flagship investment podcast for CFA Institute. I'm Mike Wallberg, and I'm going to bring your bookshelf to life a bit today, I think. Tucked in maybe next to Common Stocks and Uncommon Profits or The Intelligent Investor, you likely have a copy of The Warren Buffett Way, the best-selling book considered the authority on how Warren Buffett does what he does. It would be something to say Peter Lynch wrote a foreword for your book, or Bill Miller, or Howard Marks. And over the years, all three have penned intros to various best-selling editions and are joined on the dust jacket with endorsements from the likes of John Bogle, Charlie Ellis, Martin Fridson, and Phil Fisher. This year marks 30 years since its first press, and I'm excited to have its author, Robert Hagstrom, on the show today to talk about the recent Berkshire shareholders meeting, the DNA of the Oracle of Omaha, what's changed in the 30 years he's been writing about him, and more likely, what remains the same. So welcome to the show, Robert.
Mike, so good to be with you. Thanks for the invitation.
So before we get into the book, Robert, we're speaking just after the 2024 Berkshire meeting. So for those of us who, like me, have always wanted to go but haven't been able to get around to it, please tell me a little bit of what that week looks like.
Well, the shareholder meeting is usually the first Saturday in May, as it was this year. But Berkshire, what he calls the Woodstock of capitalism, actually begins even days before that. I show up Monday night. By Tuesday, the conferences are starting at the University of Nebraska, Creighton University, other valued conferences, client events. So it starts days before Warren takes the stage on Saturday. Columbia Business School does a great dinner on Saturday night. And it just goes on and on from morning to night. It's a rock concert of investing. And then you get to Saturday morning and, the show begins. It begins with a 30-minute video, every single year, a movie, if you will. And it's followed by 3 hours of Q&A in the morning from 9 to 12 and 2 hours of question and answers from 1 to 3. So 5 hours of questions. This year, Mike, obviously different. That this was the first year since 1978 that Charlie Munger was not on the stage with Warren. The movie prior to that was all about Charlie. It was very touching, both comedic, sad, but very touching. As Warren said, it'll be different this year, not morose, but respectful, and definitely respect was the call of the day. But it got off to a good start. The only bump in the road is, when Warren answers a question, he typically in the years past would go to Charlie and say, "Charlie, anything to add?" Well, this year Charlie wasn't there, but it was Greg Abel, who is the vice chairman and head of all non-insurance operations. And when Warren was asked the first question after he finished, he goes, "Charlie, anything to add?" And he went, "Oh, no." And said, Greg took it up and said it was no big deal. But other than that, it went off pretty much without any hitch.
So are there any key takeaways from the meeting this year for you?
Well, several. Clearly, I think a couple of things jumped out at me that I shared with my fellow Berkshirists, and they shared with me their observation is that Warren feels that Berkshire's pretty much set to go for the next 20 years. He believes that Greg Abel is the right guy. They probably already have a backup plan to Greg Abel. Ajit Jan is running all the insurance operations. They already have a backup plan to Ajit Jan. Ted Combs and Ted Wexler are still picking stocks. So they're obviously the backup plan for stock picking. But the one thing that jumped out real quickly, someone asked about the capital allocation process at Berkshire, and Warren said that will be 100% up to Greg Abel. And they pressed him on that, and that said, does that mean stock pick too, or, investing in common stocks? And he said, let me repeat myself, Greg Abel will be responsible for 100% of the capital allocation of the company. And he said, Greg knows businesses. He knows businesses very, very well. And then he said, the great line is, if you know businesses, you know stocks. So that I thought that was very telling. That was very good. The other part, Mike, was this tremendous haul of cash that he's got. He finished the quarter with $183 billion in T-bills, which is very close to the total float of the insurance company, which is the largest amount of float on the planet Earth for any one insurance company.
Yeah, he was selling a bunch of Apple in the quarter, right?
Yeah, he did. Sold some Apple, but at the same time, he took pains to say, I equate Apple with Coca-Cola and American Express and still continue to believe it's one of our best businesses. But he's got a ton of cash. He'll have $200 billion by the end of the June quarter. And he said, whether it was 1% T-bills or 5% T-bills, I'd still have that cash. And so people are, asking, what are we going to do with $200 billion in cash? And he says, the opportunities out there aren't that attractive right now. I don't think he says the market's overvalued. It's just not undervalued and extremely attractive to him.
A colleague of mine was down for the meeting, and one thing he said that struck him was that he totally avoided comparisons to the S&P 500, which is not how it's always been for him in these meetings.
Yeah.
Any comment on that?
What that didn't resonate with me. He does put the S&P 500 in the Berkshire tally of its performance over time, and I guess that's the most ubiquitous index that's used by the most people. He might, if I said to you, if you had your choice between the S&P, maybe a S&P equal weight, I wouldn't be surprised if he said, the equal weight is just as good. As we all know, the problem with the S&P is that the mega cap guys, are kind of running the roost now, 25, 30% of the weighting in the index. And although he has Apple, he doesn't have anything else. Next one up would be, between Coca-Cola, Bank of America, and American Express, but they would be much further down the list.
You write that Warren, it's funny actually, it feels wrong to call him Warren to me for some reason, or to call him Mr. Buffett. It feels like the only right way to refer to him is as Warren Buffett. Yeah. But anyways, you've written that he violates every dictum of modern portfolio theory. What do you mean by that?
Well, we actually did a lecture at what's called the Value X conference on Friday afternoon, and my lecture was, how this whole modern portfolio theory, which is now embedded into the standard approach to portfolio management for equity, being broadly diversified, non-correlative assets, perceiving price to be the risk that you must manage, going back to Markowitz in 1952. Warren has nothing to do with any of that. In fact, he basically says, this doesn't make any sense to us all. So if you kind of reconstruct what's going on at Berkshire as a portfolio, it's a concentrated low turnover portfolio. It doesn't care about bounciness. He's often said, I'd rather have a bouncy 15 than a smooth 10. He eschews everything that is about modern portfolio theory. And it's obviously done extremely well. And we wrote a book, 1999, called The Warren Buffett Portfolio, but after The Warren Buffett Way, because I hadn't talked about portfolio management in depth in the first edition of The Warren Buffett Way. I think I said something like, Warren buys stocks and holds them forever. That was the essence of portfolio management. What I wanted to do was get the stock picking right. So we revisited portfolio management, and we looked at Warren's portfolio, the Buffett partnership, Charlie Munger's portfolio while he was a hedge fund manager. We looked at Bill Ruane at Sequoia Fund with Rick Knapp. We looked at Lou Simpson, who was managing the Geico portfolio, and John Maynard Keynes, who had run the Chess Fund. He was actually the very first focus investor. And Warren called it focus investing. I told him I was going to write the book. He said, well, Robert, we just focus on a few investing. I said, well, focus, that's a pretty neat name. But he said, well, nothing proprietary about it. If you want to call it focus investing, call it focus investing. So we called it focus investing and looked at the behavior of these focus portfolios. And it's remarkable. All of them significantly outperformed the market over their time period. All of them had wide standard deviation results relative to the S&P 500. And believe it or not, with the exception of Warren, who had a perfect track record of 13 years outperforming the market, all of them underperformed the market, 40, 50% of the time. And so, so this is a little bit of a different game than modern portfolio theory, which would say, I don't like this underperformance. I don't like this standard deviation. And they try to stay as close to the market as they can and not have significant drawdowns. But at the end of the day, their broadly diversified, non-correlative portfolios don't beat the market. We know that. And these portfolios do beat the market, but they violate every tenet that's in modern portfolio theory. So today, the academicians, as you know, might call it high active share investing. I think it's Martin Kremers and Ajit Panajusto at Yale, who finally got to the mathematics of it and said, yeah, actually the only way to beat the market in their mind, high active share portfolios, which is a percentage of how different your portfolio is to the market. And then they went on in the second paper to say, not only is it high active share, it's low turnover. So the academicians are saying, if you're going to beat the market, you need a high active share, low turnover portfolio, which is exactly what Berkshire Hathaway is.
And it's funny because it's not like he's trying to build a high active share portfolio. I think the high active share calculation falls out of his process, which is I don't care what the market is.
I
want to own the businesses that are going to outperform, and I'm going to hold them forever, basically.
Mike, you're exactly right. If I said, Warren, what's a high active share? You wouldn't even know what it is, right? You wouldn't have any idea what I was talking about. But in fact, that's the way you beat the market. And Crimmer says it is actually now a predictor of performance. It's either going to be very good performance or very bad performance based upon your stock picks, but you're not going to be hugging the market. And so, I don't know how much you want to go further into this, up to you, but, the lecture question was Charlie S. in 2017. He said, if Berkshire is so right, and we've done such a good job with this approach to portfolio management, why are so many eminent places wrong? Why aren't so many other people imitating what we do? And I've always thought that was a pretty interesting question.
Yeah, well, I guess if more people read your book and maybe don't pay as much attention to to their finance text, then maybe we'd have more people buying and holding, and I guess not everybody can outperform, but maybe more will.
Well, I would say this, and we can move on to whatever you want, but I would say this: when I wrote the books, all the Berkshires, I call them Berkshirists, people that are loyal to the Berkshire Way, said, Robert, quit writing these books. You're giving away all the secrets. All these people are going to figure out what to do, and they're going to start to make it harder for us to make a living. I've been writing about Warren Buffett for 30 years, and still people are not falling all over themselves to run concentrated low turnover portfolio. I've never met anybody who said, Robert, I'd say, this is what we're going to do. We're going to do the Warren Buffett way, how Warren thinks about stock selection. This is how we're going to value him. We're going to buy it whole. And people raise their hand and say, yes, 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 I'm all in. Let's go. About 9 out of 10, well, that's not fair. Maybe say 8 out of 10, 6 months later, have lost their mind because the market's doing one thing, we're doing another thing. The volatility is high, the standard deviation. I've had 2 quarters in a row of underperformance, which, is not unusual in high active share. And so what has happened is they believe in the method. They believe in the process. They just don't have the right temperament. And temperament, I'm 100% convinced now. I used to overweight method and underweighted temperament, thinking if you understood the math, temperament comes second. Everybody understands the method, sure, but the temperament is a hard thing to wrap your hands around about being a business in a market that's pricing every day and the psychological blowback that comes from when prices change. It's very hard for people to get that under control.
It's about being selective in your clients, I guess, as well. I mean, I had that experience with my mentor when I was, coming up and learning equity investing, and we worked for a larger firm, and he eventually left and started his own, and he has been very selective over the years, filling him down low, and he started his own firm, and he's just like, okay, I want a certain number of clients, I don't want too many, and here's how much you're going to hear from me. And it's basically a Berkshire Hathaway approach to it, saying you're going to get a letter a year, and this is what the return profile is going to look like, and I'm not promising to match the market. And he's a smart guy on top of that, but he's been killing it for about 16 years now. So it's
you wonder why people don't pay attention to that more often. I mean,
yeah.
Here's a guy that's saying, I'm not going to get. So modern portfolio has a set of rules. They play the game this way, and this is their rules of how you should play the game. The Berkshire model and your friend's model is a totally different model. But to require us to play by the rules of modern portfolio theory when we're playing a different game is nonsensical. We have different rules. Price volatility is not a concern. Periodic underperformance is not a concern. More about magnitude, not frequency. It's not how many times you beat the market, less how many times you don't. It's how much money you make when you beat the market, less how much money you get back when you don't. And if you're a good value investor in your high active share portfolio, when you underperform, you just don't underperform by that much. You're not giving back wholesale. But we have different rules and different ways to play the game. We're more interested in the economic returns of our business, look through earnings, return on cap, sales growth. As it, I made the analogy. I said, this way we're investing money is like private equity, public securities. Think about how private equity does it. They don't have common stock prices, so how do they measure their performance and their progress? Economically, sales are this, and margins are this, and our returns are this. I said, that's the game we want to play. It's just because we have a stock price, we're forced to play it differently. I said, well, we've got to find people who say, yeah, I understand the prices are there every day, but I want you to be a private equity guy who is basically owning some very good publicly traded companies, but behave as if you're a private equity. Don't behave like those other people, who are underperforming the market every year.
The standard deviation or tracking error, I guess, as well, is what we're talking about.
Yeah.
Kind of a false definition of risk, I guess. If you have a long enough time horizon, You don't let that be your definition of risk. And I guess the only exception to that would be if you don't have an infinite time horizon and you do have need for intermittent cash flows and you need to think about, what drawing down capital in a down year, for example.
Well, to that point, Mike, I would say then it's an allocation problem. If you need cash flows and income, then maybe you don't have 75% of your money in stocks. As Warren would say, the risk of me buying and holding Apple for the next 10 years is about zero. The risk for me buying and selling Apple next week is huge. I don't know what the price is going to be next week, next month, quarter. And so if that's important to you, you shouldn't be in a stock. That's for sure.
So we've talked around in general about Warren's approach to the market. I wonder, just for any listeners that haven't followed Warren Buffett's career and his approach, and if you had to boil it down to 4 or 5 things that he does differently from the average investor besides ignoring the noise, what would they be?
Well, I think there's, I would say 3 or 4, which is, one, think about stocks as businesses. His famous line is, I'm not a stock picker, I'm a business picker. And when you're a business picker, you're thinking about things differently than if you're a stock picker. With stock picking, as we were saying, Mike, you're worried about beta, correlations, and standard deviations, right? All that nonsense. He doesn't care anything. He's just, what is the economic return of this company? What is if it's generating cash, great. Now, what is the cash return on capital? It's above the cost of capital. I'm interested. Below the cost of capital, I don't care. And then what are the long-term prospects? How long can this last? So one is to think about stocks as businesses first. Stocks are businesses first, as opposed to what people start with today. They think about stocks first and then, what's the business? So he starts with the business. Second is to demand a margin of safety in every purchase. Anytime you buy anything, great company, an average company, whatever, you want a discount to that intrinsic value. Perchance something in your calculations, something in your estimates, something in the projections of your competitive advantage period change for the worse. By buying it below its intrinsic value, you will limit your downside. So stocks as businesses, margin of safety. And then he would say, don't buy every stock under the sun. You only need a few. As he said, treat your life as it's you got a punch card with 20 choices in it. You can only make 20 choices, and be very careful about how you do it. Hold on to them a lot. And then the fourth part is, have the temperament that you're the boss of the market not the boss of you. The market's only there to serve you, not guide you. And so he, even though Warren's a great market celebrity, his success is a purposeful disengagement from the market. Even though he's on CNBC and he does all that, he doesn't care about the stock market. I talked to his secretary, Debbie. I said, Debbie, does Warren have a TV in his office, and does he watch CNBC? She goes, the video's on, but he never has sound on. He's just using it to see if there's a news alert or something. But he never listens to any of the talking heads on CNBC. And I said, well, that's probably a pretty good piece of advice, right? So stocks as businesses, margin of safety, concentrated low turnover portfolios, and learn to manage the market to serve you. Don't let the market guide you. I would say those are the 4 principles.
What has your interaction been with the great man over the years?
Very, very professional. Our relationship is all about the books. I did send him, when I told him we were doing the 30th anniversary, of course, he saw the book ahead of time. And I'll back up. So when we wrote the book in 1994, and I had decided that I was going to write this book. I'd been studying Warren since 1984 when I was a stockbroker, and I decided I wanted to write the book. But as you know, Mike, those annual reports are copyrighted. I think it's the only chairman's letter in the country or in the world that's copyrighted. And I wanted Warren's voice to speak through the book in describing how I thought about, or how he thought about stocks as businesses from the business, management, financial, and valuation perspective. I wanted his voice to come through. So I sent him a letter. I said, Mr. Buffett, my name's Robert Hagstrom. You don't know me, but I'd like to write a book about you. May I have your permission to copyright? And this was, 92, 93 going into that, and weeks went by. Finally, a letter comes back, crisply typed. On the back says Kiewit Plaza, Omaha. I knew exactly what it was. I opened it up and, he said, Dear Robert, thank you for the letter, and said a few things. He says, I can't give you copyright permission just yet. Well, being in sales, I knew not just yet wasn't a no. It was just, what do we got to do to get this done? And the deal was, back in 1994, that he wanted to see every chapter. He was very reluctant to want to do a book. He didn't want the get-rich-quick schemes of Warren Buffett or how to make $1 billion like Warren Buffett. He wanted to know what I was going to write, how the book was going to be titled, how we were going to do the market. So I had to send him every chapter in 1994. all the way through the end. And he did give me copyright permission, and he did not change anything about the book, which I'm glad he didn't, because basically I took his words and said, well, these are your words, and this is how you think about it. So he didn't change anything. And he wrote me a couple of nice letters, and he was very supportive. Since then, our relationship is, if I'm writing something, I let him know I'm writing it. I tell him why I'm writing it. I send him everything. And he always is, very nice about it. The last time I said, Warren, they wanted to do a fourth edition of the Warren Buffett Way. I didn't really want to do it, but then they came back, and Wiley very nicely said, let's make it a Wiley Investments Classic. And that's pretty cool, because if you look at the lineup of the Wiley Investment Classics book, it's kind of the who's who. And these books stay in print. So you've got things like The Go-Go Years by John Brooks, one of Warren's favorite, Common Stocks and Uncommon Profits by Phil Fisher, Extraordinary Popular Delusions and the Madness of Crowds, Manias, Panics and Crashes, Reminiscence of a Stock Operator, one of Bill Miller's most favorite books, The Battle of Investment Survival, Where Are the Customer's Yachts? Warren's talked about that. And then, Super Money by Adam Smith, and a couple of books by Jack Bogle. And I thought, well, I think Warren would probably appreciate having the Warren Buffett Way in that library. So when I sent him the book, I said, this is the reason why we're doing it. And he was so pleased. He said, right, I'm delighted. I'm delighted that you're doing the book. I'm pleased that you're doing the book. And so that was it. So our relationship is all book centric. As I say, we exchange emails a couple of times, maybe a year and such. And that's it. That's fine with me. And that's fine with him. It works out very,
very cool. So you mentioned making the market serve you and looking back 30 years. How has the market changed, do you think? I mean, it's not the same market. The market is, we've got a lot of other stuff in there, high frequency trading, crypto, all that kind of stuff. Like, markets have changed. How has Warren's approach changed over that time period, or haven't they?
Yeah, I don't think Warren's approach has changed that much. Now, he went through a couple of evolutionary periods, as we well know. When you read the Berkshire annual report this year, and the first page was a testimony to Charlie Munger being the architect of the modern day version of Berkshire Hathaway. He evolved from the strict disciplines of Ben Graham, low PE, low price to book, cheap stocks, but not good businesses. The stage that he evolved to was Charlie saying, let's buy better businesses at fair prices so they can compound over time, give up this low PE stuff. So he did pragmatically evolve to that step. I wrote that I also thought he was one of the great growth investors. If you go back and look at American Express and Coca-Cola, they were all, the time he purchased them, were all growing faster than the market, had PEs higher than the market. So he kind of morphed into being a growth guy that understood valuation, and that worked out well. But the Apple, that was kind of the last stage. Bill Miller picked up on that early in the late 1990s when I worked with him at Legg Mason Capital Management for 14 years. And Bill was the first value guy to understand the value of technology. And he understood that the new moat was network economics. The networks were the new franchises. Warren was a little slower on it, but he made a big bet, $35 billion on the iOS network at Apple. And that was a 5-bagger. So he continues to learn. He's not always the first out of the gate, but continues to learn. So his thinking about value does evolve as value has migrated, right? Value has migrated. It's interesting today that, value is more in the companies that are investing a lot of money in tangibles, intellectual capital, whether it's a pharmaceutical company, a software company, technology. It's intangibles that seem to be creating the most value. Whereas in the old days, it was brick and mortar. You thought about, how much brick and mortar, trucks and equipment, and that's how you thought about the future intrinsic value of your business. Today, that's less that. We're investing more in intangibles than we are tangibles, and that's the value creation. So Warren's picking up on that. But to your point about what's changed about the market itself, I find fascinating. And I would really like to do some work on this. What I'm fascinated is that the species that has come to dominate the market today is probably the highest population, or defined as assets under management, is increasingly becoming the alternatives, quant-driven algorithmic traders that are levered, that have billions, that are moving with lightning speed in a somewhat illiquid market, forcing prices to deviate largely, wide deviation of prices. That the structures of markets have changed. Speed and magnitude of price change are faster than I've ever seen. And that's okay. I think it was David Einhorn who said that he thought value investing is dead. I don't think it's dead. I don't think there are as many of us as there used to be 20 or 30 years ago, but there are great opportunities to pick off the mistakes of the species that is quant-driven, algorithmic, levered traders in the market, because they overshoot. They overshoot on the upside, they overshoot on the downside. So think about third quarter 2022. I mean, they just crushed growth stocks all year long. I mean, it was the easiest money in the world. Every time the 10-year went up in yield, you just shorted the Russell 1000 growth. And they printed money, for 9 months until we got to about October. And it was just ludicrously cheap. I looked at my portfolio and thought maybe we're probably 30 to 40% undervalued. But when they overshoot and they get it wrong, there's huge opportunities for value investors. And so one of Warren's favorite sayings is, widespread fear is your friend, right? When the market is just totally lost its mind, that is the best time for you. And I've made money during the pandemic when everybody gave up. We made money when, we went through 2022, we made money. When you get these widespread points, that's when value investors swoop in and they can make 3-4 years worth of returns just by buying. Then he says, personal fear is your enemy, at which point you lost confidence in your selection, that you think maybe the market knows more than you know, that you're second guessing yourself. You're done. You're sunk. As he said, it's like being in a poker game. You don't know who the patsy is. You're the patsy. You don't have a firm idea of what you're doing, and you think the market's better at it than you are. Get out of the game, because you won't win that.
Buffett said last year, write your obituary and try to live up to it. Something I understand he actually reiterated at this year's meeting. Not to ask you to follow the oracle, but final question I like to ask all guests on the show, Robert, is to reflect back on your first working day in the industry and consider what key piece of advice you'd offer yourself. So where were you on that day, and what would you say?
Well, I went into production 1984 after completing, 3 weeks of training at Lake Mason, where on the next to last night on a Thursday, I thought I'd made a terrible mistake getting into the investment business, because I was a liberal arts major, knew nothing about accounting and economics. And that last Thursday night, our lesson for the night was to read a Berkshire Hathaway annual report, which I'd never read, never heard of, written by a guy named Warren Buffett, which I'd never heard of. And I read it that night, and of course, that was the epiphany, right? It was the light bulb goes on, stocks are business. But the bigger issue here is, I think, in any business that you're in any industry, you need to find out, who the exemplars are, who are the best, who are the people that have done the best at this, and then just study them. Just engross yourself in those that have been successful. Read everything you can about them. Read the books that they have read. Just consume yourself and imitating. As Warren said, I didn't do anything original in life. I basically imitated Ben Graham for so long. Then I imitated Charlie Munger. So life is not so much about originality. There's only a select few that are original thinkers in any field. But success can be multiplied over and over by simply imitating who's the best at what you're in.
I've been speaking today with Robert Hagstrom, Chief Investment Officer and Senior Portfolio Manager at Equity Compass, and author of 7 books, including The Warren Buffett Way, now out in its 30th anniversary edition. Thanks so much for coming on the show today, Robert.
Mike, thanks so much for the invitation. Good luck to you.
I'm Mike Wallberg, and this has been The Enterprising Investor.